Accounts are accounting records used to record financial transactions and explain changes in assets, liabilities, capital, income and expenses. Accounts are the most basic form of summary in accounting. In accounting, accounts have several functions, including, record financial transactions chronologically based on transaction date describes additions or reductions to specific assets, liabilities, or equity becomes the basis for preparing financial reports. Accounts are divided into two, namely real accounts and nominal accounts. Real accounts are a group of accounts that are recorded and reported in the balance sheet of financial statements. Meanwhile, nominal accounts are a group of accounts whose transactions are recognized in the profit and loss statement. Apart from accounting, accounts can also mean accounts at banks and/or other financial institutions. User account, namely a user who can access a computer system or email address. Internet accounts, namely accounts created within a limited system established by an internet-based service. Next, we will get to know the 5 types of accounts in accounting, including asset accounts, liability accounts, equity accounts, income accounts, cost accounts. Account classification is a grouping of accounts based on their type or classification. Account classification is a method used to record transactions to control finances. 1. Asset accounts. An asset account is a category in a company's ledger that shows the value of assets owned by the company. Assets are the resources a company has to run a business and are expected to generate profits in the future. 2. Liabilities accounts. Liability accounts are part of a company's ledger and balance sheet that record all debts that must be paid to other parties. Liabilities themselves are financial obligations or responsibilities owned by an entity or individual. 3. Equity account. An equity account is an account that records ownership interest in a company. Equity itself is the right of the company owner to its assets after deducting obligations or liabilities. Equity is a part of the financial report that shows how much the owner or shareholder claims on the company's assets. Equity includes initial capital, retained earnings, and other investments. 4. Income account. A revenue account is an account in the accounting system that functions to record all income received by a company. Revenue is the result of a company's business activities, such as selling goods or services, renting assets, and other business activities. Revenue accounts are also known as nominal accounts or temporary accounts. This account records business income, expenditure, profit and loss transactions in a certain period. 5. Cost accounts. A cost account is a part of cost accounting that includes all costs to purchase, deliver, and prepare assets, as well as to train employees in their use. Cost accounting itself is the process of recording, classifying, analyzing and reporting costs incurred by a company for the production of goods or services. What is account balance? Is the amount of money in an account or financial storage in a certain accounting period. The account balance is the net difference between credits and debits recorded in the accounting cycle. The account balance may reflect the amount owed or net debt. Account balances can be seen on billing statements for credit cards, utilities, and loans. In accounting, normal balance is a concept that regulates financial recording. Normal balance shows the standard position an account is in the debit or credit statement. Normal balance is important in bookkeeping because it is used to analyze financial statements. 1. The normal balance for an asset account is a greater debit balance than a credit balance. This shows that the debit side has a greater influence on the asset account. 2. The normal balance of a liability account is the credit side. Normal balance is a standard position that shows an account is in debit or credit. Normal balance is an important process in bookkeeping financial statements. 3. The normal balance of an equity account is a credit. The credit balance in the equity account shows the wealth gained from building the business. 4. The normal balance of the revenue account is a credit. The normal account balance is the positive difference between the debit and credit sides of an account under normal circumstances. The normal balance of the revenue account relates to the activity of selling goods or services. Income is the result of acquiring assets or economic resources from other parties. 5. The normal balance of an expense account is a debit. This is because the cost account is on the right side of the basic accounting equation, but has a negative sign. To enter transactions into the general journal, follow these steps. Transaction identification. Determine the transaction that occurred and identify the accounts involved. For example, purchasing goods, selling, or paying debts. Define debit and credit accounts. Every transaction will affect at least 2 accounts. Determine which accounts will be debited and which will be credited. The basic principle of accounting is that debits must equal credits. Record date. Write the transaction date in the appropriate column. Transaction description. Provide a brief description of the transaction to explain the context. Enter amount. Write the appropriate amount in the debit column for debited accounts and in the credit column for credited accounts. Mark the journal. After recording, make sure to check and mark the journal so that the transaction is recorded correctly. Example. If you buy goods for 1 million Indonesian rupiahs in cash. Date. October 1, 2024 debit account. Inventory, Rp 1 million, credit account. Cash, Rp 1 million, description. Purchase of goods. The general journal will look like this. Date description debit credit the 10th of January 2024 inventory 1 million Indonesian rupiahs cash 1 million Indonesian rupiahs purchase of goods. After these steps are completed, make sure to prepare financial reports periodically based on the general journal that has been created. That's all the explanation from me. Thank you for watching.